Now, when talking about technical analysis is pretty much the framework in which any Forex trader really studies price action or the movement of price. Now, the theory behind technical analysis itself is that a person can pretty much look at a historical price movement and determine the current trading conditions for a potential price movement. Now, when really looking at technical analysis and reading price action, the ideology behind trading is where price is more likely to move next. You know, what side has a higher probability. Now, typically when you trade, there's only two sides you could really take, which is going long or going short, right? So it's all about building a list of confluences or following a certain strategy, right, that will help you make this decision. Now, typically the main evidence for using technical analysis is that, you know, theoretically all current market information is reflected in the price. So for example, like if price reflects all of the information that is out there, then the price action is all one would really need to make a trade, right? So typically you're not going to need a million indicators, right, on your screen, or a bunch of random lines out on your screen either. Typically all you really need is price action to actually trade. Now, the biggest reason to actually study price is to look at the patterns and what price does at certain levels, and really overall study the market patterns themselves, read how price moves. Now, price is going to move very differently for each and every pair. No pair will move exactly the same, right? So now if we take a look at the actual price action chart, right, all we're really going to be reading are the individual candlesticks here, and we're going to be looking for what price could probably do next, right? So if price, again, you're going to learn about support and resistance later on, right? So, you know, once you kind of get to that video, you can always come back and reread this one. So we're going to be looking for the next high probability trading setup, right? So let's say price at this black line here at this specific level, right, this level of support had rejected this level of support, and sellers actually maintained that level, buyers maintained this entire level of support, right? Then what I'm going to be looking for is for price to test that level of support, and the probability of price to continue to go down, since sellers have held this support for quite some time now, the probability of price to continue to go down is a lot higher than the probability of price continuing to break out to the upside. How can we tell this? Well, it's all about reading price. The candlesticks are getting smaller towards this area of previous support, now turned into an area of resistance, as you can see here, right? We also see big wicks to the upside here, right? So the probability of price to actually reject this level and go down is a lot higher than price to actually continue to go up. Now, of course, I could easily be wrong in this. No technical analysis is always going to be 100%, right? So after we perform our analysis, we look at the risk versus the reward, which one tool you could use here is a long or short position. So if I were to enter a trade here, where would my stop loss have to be? Well, preferably I would like to enter my stop loss above the high of this specific level. Now, where would my targets go? Well, you know, if price rejects this level of resistance, price is most likely going to go back down to support, which could be found in this zone or this box down here. Well, can I at least get, you know, at least 1.5, 2 times my risk? Now, we could see on this specific trade, right, if I do take it, I can at least obtain a little bit more than 2 times my risk, meaning I'm going to make, you know, I'm going to be risking $10 to make $20, $100 to make $200, $1,000 to make $2,000, right? It's a little bit more than that. The risk reward ratio is a 2.62. So it's a little bit more than that. So after you perform your analysis, you kind of look at the risk and what type of risk you're going to take on the trade, and then look at the probability along with risk versus reward. Now, you know, in the world of currency trading, when someone says technical analysis, the first thing that comes to mind, it really is a price action chart. And all you really need is that price action chart. You don't really need all these big and fancy indicators. So you can actually just, you know, perform your analysis without any confusion, Now, typically, reading price action will really come with, back testing and really learning about the market and having experience in the market. Now, we're going to be going over more, of course, later on in the course, more sections on how to actually read price action, how to actually read momentum. But when it comes to technical analysis itself, traders are typically, marking off areas of support and resistance on the chart, looking at the overall trend and reading what price is doing itself. What's up, everybody? So I'm going to be going over the kind of fake out pullbacks, the kind of more complicated pullbacks within the market. So normally what they look like, and the reason why this happens is, again, to trap retail traders and take their money. So pretty much I'm going to have an example here of let's do it for a bearish trend. Right, so normally this is kind of what the pullback looks like, the fake out pullback. Right, I'm going to be explaining how to actually spot this and how to actually not get faked out by this. Let's do it for a bullish trend. Right, so then we have here, then continue lower, then a push back up. We can make this a little bit lower here. Overall, what this is meant for, it's more of a psychological trap for retail traders, for the smaller traders to actually provide liquidity. So overall, let's move this up here. So overall, here we have a bearish trend. Now keep in mind from the previous lessons, a trend is confirmed when we have that three-legged move. So 1, 1, 2, and then 3. Right, so normal people would think this is a regular bullish trend that is confirmed, but you have to keep in mind, right, in a bearish trend, a lower low is not confirmed until we do what? Form a new low, and we break past the previous low. So in this case, the lower low is confirmed, and if the market breaks this lower high point, then it is a break of structure. But in this case here, the lower low is not confirmed, and this is not a confirmed lower high point. This is still our lower high point. So unless the market breaks this area up here, forming a higher high, then it's still considered to be in a downtrend. The market fluctuate all at once between here before forming a lower low, and the downtrend is still valid. Now the same rules apply for an uptrend. Right, so let's say this was our previous higher high. Let's say this was our previous higher high, this is our higher low, this is our new higher high. The market is still uptrending unless we have a break of our previous higher low. So this does not make it confirm that it's our current higher low. It's confirmed only if we break past our higher high, forming a new high. And then again, vice versa for the downtrend, right? This would be our new lower low if the lower high point that was created here were to come down and make a new lower low, right? So what this actually does, it pretty much fakes out people. So essentially, they'll start selling at this area here. Their stops probably go somewhere along this area here, right? Once they see their trade kind of slow down and start going against them, they'll most likely start exiting their sell positions and start entering buy positions. So it starts creating a lot of buying pressure, so it pushes the market up higher. But then overall, it is manipulated and the market continues to go down to form new lows and also providing liquidity. So that's pretty much a small breakdown of the actual pullback itself. Of course, you want to backtest this as much as possible when this video is done. Go back in the charts and find 20 examples of these, right? So then again, same thing for the uptrend. So we have the higher high, quote unquote higher low. People start buying at this level here. The market goes against them. They think it's a break of structure, right? When it really isn't a break of structure, right? It's still in an uptrend. Then they start entering sell positions. Then that pushes the market down, of course, because more selling pressure is created. But then overall, the big boys, the market makers, end up pushing the market up and further to make new highs. Now we could see a perfect example of that right here, right? So here we have our previous higher low point. Here we have kind of that higher high, right? It's confirmed to be a higher high when we broke above and closed above this level up here, right? So unless the market breaks this higher low point here, we're not in a downtrend. So what happened? We had a pullback, then what looked like it would have been a continuation upward. We stalled, came back down even lower. Selling pressure was created and the market was being manipulated. And what happened? The market was pushed up higher. So later on, we're going to actually get into how to actually trade these types of opportunities here. All right, so let's get rid of that, and let's get rid of this here. Now let's see if we could potentially find one for a bear trend here. So potentially there's one right here. So right here we have that lower low, and here we have our lower high point. Okay, so once the market came down, we had a nice kind of bearish push there. We had that pullback. Then it looked like it was going to continue to go downward, but it was just a counter trend there. Market was pushed up higher, consolidated for a little bit there, and then we saw a continued move down, and then the same thing happened again. We pulled back, and then we saw that initial push back down. So then this would be our confirmed lower high point. So then now this is our new lower high point here. Okay, so then we had a nice lower low, then we just had a lower high point and a continuation. So as you can see, this is not our new low. We didn't close under this level here, right? We simply just formed a low. So market was pushed back up, and then again, this wouldn't be a valid double bottom pattern as well. We'll get into that later on in the course as well. Came back down, pushed back up, then a continuation of the downward move. So you could see kind of that manipulation there, right? So let's say if you were to enter here, then your stops have to go above these highs here. Okay, now this lower high is confirmed once we made a lower low point. This is probably not the best example. The best example would have been this move right here for the actual downtrend itself. Let me see if I can find one for the actual for an uptrend here. So we're on the hour time frame, so it's a little more noisy, or you see a little bit more detail there. Potentially this would just be a normal double bottom pattern. Potentially we have one for an uptrend. I would say this isn't the best one here as well, because this is pullback. Because here we have higher high, then we have our higher low point, then we have our higher high, then we have our higher low point here as well. Then we have this kind of high. The market started coming down. Then again, I mean, you could potentially call this a complex pullback, but it's congruent with the trend, so it's not really something I'd be paying too much attention to, right? So I'm trying to find the best examples possible. Maybe I'm not going to get the actual best examples. So we saw one for an uptrend. Let's see if we could find one. Find a better example for a downtrend here. Okay, so I would say right here would be one, right? Because if we look at this in real time, me personally, I wouldn't see any interest in taking this trade here because we're not near previous structure. But if you look at it in real time, it does look like it'll continue that downward move. So we had a nice lower low, the pullback, and then it looked like it was going to continue to go down. But then we had that push back up, came down, then eventually, if we look at the actual swings, that would have been the lower high point, continuation of that lower high point. So we're going to learn how to actually trade this later on, but you could see that manipulation there as well, right? So what I want you to do is pretty much go back on your charts and look for these examples and start memorizing them, right? Look for these examples and start memorizing them. So let me do that, right? So what the actual move does look like is like this, right? And start memorizing these patterns, because these patterns are the ones that are manipulated the most, of course. So go back in your charts, start memorizing these patterns, and then later on we'll learn how to actually trade this. So I just wanted to go over that kind of complex type of pullback there. Now, these weren't the best examples possible. You could probably find better examples on a more condensed time frame, right? Such as the 4-hour time frame. So let me see if we can find one here really quickly. So where could we potentially find one there? Right here. Okay, so we had that swing up, swing back down. The higher high was confirmed once we broke above this level here, right? Higher high is confirmed. We broke above, we pulled back. It seemed like it was going to continue to go up, but then came right back down. Then we had another push up, then again came right back down before actually continuing to make new highs. Got a retest and then a continuation. So what I want you to do is, before of course learning how to actually trade these setups and how to actually spot them real time, because you're not going to be able to spot them real time, right? It'll look like it's going to continue to go up here. We have previous structure, then slowly as the candle starts forming, we start seeing a lost momentum. Then by the time you know it, you're probably panicking and closing your positions and looking to enter sell positions there. So we had a continuation of that bull trend there, and so on and so forth, right? So overall, I want you guys to go back and look at maybe 10 to 15 examples where you potentially see the previous drawings that I had showed you up here, right? Just so you can start memorizing what these patterns actually look like. And then we're going to find ways in that video how to actually avoid entering those types of positions there, right? Kind of building a more of a criteria list and so forth. That'll be in the later section of the online course, right? This one was just kind of an introduction to the actual pullback there. So I'll be speaking to you guys in the next training video. What's going on, everybody? So I want to go over kind of how to kind of mark down a certain zone where you're going to be looking to enter. Now, overall, we're going to be in a trending market here on UJ. So we can clearly see that we have kind of a high there, then a higher low, then we have a higher high, then a higher low, oops, wrong tool, then a higher low, then a higher high, right? And at this point in time, we can kind of look for an area where we can expect the market to come down to. So I'm going to fill up that wick, and anywhere between this high and this low is where I will be looking to enter. Now, you can get a little more in depth with this, right? So you could see, okay, we have our internal structure here, so let's see what that lines up with, and you can have your Fibonacci retracement tool out as well. You can see that's okay with the 78.60 there. So let's say your first zone, let's say it enters the zone and it continues to go down, then you kind of want to look to see a potential where the market could continue to go down to. Now that was just a quick example for the uptrend. Now let's see if we can find one for a downtrend. Sorry, this was the previous video. Actually just clear the chart, right? So it's really just about looking for specific zones where the market could potentially retrace to, right? And that's mainly, you're gonna have to go with market structure there. Okay, so let's see if we can just find another example over here. Okay, so clearly here we have this lower high point, right? So anywhere between this area to this market structure low is where I will be looking for a potential reversal and a continuation of the downtrend. And again, you can continue to look for specific areas where we could potentially see a reversal at. So here we have kind of that internal market structure there. And again, you know, you can also use your Fibonacci tool for confluence as well, from the high to the low. And we can see, oh, here we have the 78.60 and etc. So this is just fairly simple video, mainly just to go over application. But what these entry zones is to pretty much kind of narrow down where you're going to be looking to enter. And if the market continues to go, then you know you're just basically going to sit on your hands. Again, you want to be very disciplined. You want to have very crucial rules of engagement when you are looking to enter a potential trade. So you know, here's just another example. So here we have these kind of structure lows down here. We have these structure highs up here, right? Again, you know, you could be looking to enter anywhere in this zone. You'll be either waiting for some form of a reversal candlestick, or it really depends on your trading style. If you're more of a person who likes to use limit orders and get in at a specific price, then you'll wait for that. If you're someone who likes to see a specific candlestick, then you'll be somebody who's waiting for more confirmation, right? So again, it continues. Now let's say here we have this downtrend over here, right? So here we have these market structure lows right here. We're going to go from the wick and kind of highlight all of that, from the low to the high, And then we can kind of narrow down where we could potentially see the market retrace to. So it's really all up to you how you want to draw these zones. We definitely want to have this zone. So if you don't want to go from the wick, you just want to do body to like the body to body and see like a specific area as well. So this would have made more sense here then. And then again, you want to be using your Fibonacci retracement tool as well to see what areas have confluence. As you can see, we have this low here and we have that 50% retracement there as well. And kind of build a case to entry. You don't just want to be entering just because it hits a random level on your Fibonacci retracement tool there. So overall, in consolidation, it'll be a little bit more difficult to have these zones. This is mainly for trend trading, see where the market could potentially pull back to. So let's say here we have kind of this zone right here, right? So as you can see, in this case, the market did pull back and we didn't quite reach that zone, right? But in our Fibonacci retracement tool, we can go from the lower high to the lower low point. Potentially you would have seen that's a 6180 there as well. Fairly simple concepts, just put together in different situations, right? So again, this is just for simple kind of application, how to actually draw these zones. In the next couple of videos on the line, the actual depth and detail on how to actually put everything together will all come along. So you just want to be looking for specific zones. Now this is on the 4-hour time frame. You'll probably be able to use this a lot more efficiently based off of the hour time frame. So this is current price action. Right, let's go a little bit back more. So let's just say maybe somewhere along we were here. Okay, so again, here we have previous structure highs. So this would be an area. This is going to be the area we're going to be looking to enter at. Right, and again, you can use your Fibonacci retracement tool as well from the low to the high. Kind of broke under the 38 there. We don't really have all too much confluence there, but it continued to go up after that. We're going to be pretty much drawing zones now. Can't really find the most perfect example, right? Potentially, I'm trying to find a great example here. I'm not really getting the best ones. In trading, everything isn't going to look perfect, right? But overall, here could be another one. So, right, the market is consolidating here. So, anywhere between this kind of high to this low here is where we'll look for a potential entry point, right? We could see the market came up, tap that, and continue to go down to form new lows. And simply, we just can readjust this box and look for different entries in the future as well. Right, so we could see a retest of these structural lows and continuation of that kind of downward trend there. So, it's fairly simple concepts you want to be putting together in different situations. Now, if you were to do this in a consolidating market, such as this one here, then it'd be a little bit different, right? So, more or less, you'll be looking for some form of a reversal pattern. So, let's say here, right, at this point in time, you'd be drawing it from like here to here, now to the future. And you could see that as well, that was retested later on in the future. You could see a continuation of that downtrend there. So potentially you could have also done it here as well, right? And then again, this would be for the double tops, right? That's a whole different video. But again, just a really simple concept that you want to be putting together. So pretty much the kill zone, if you want to call it, is measured from the previous high low to the new structure higher low, right? The most recent pullback is where you want to measure it from, right? So in this case here, right, with current price action, here we have the previous low, right? Here we have the previous low to that previous high there, right? So we'd go from here to here. We'll be looking for an entry point anywhere along this area. And again, you could use it with confluence with other levels as well. So I'm just going to go on my regular chart here. Let me see. Okay, I'm gonna go on my regular chart here. So when I had my zone drawn out, I was looking for an entry anywhere between that low to this high, right, where we saw previous structure. And as you can see, it came down a little bit lower than that. So I wasn't expecting to enter right here, right? But on the Fibonacci retracement tool, right, I saw that the 618 had, actually my fibs is placed wrong. I saw that the 618 had some confluence with this key level here, which also lined up with these structure highs, right? And again, you're going to be building a case to entry, and as you can see, the market did reject that area, and kind of, you could look for potential opportunities based off of that. So, just small examples. It's going to be going a little bit more in depth later on how to combine everything together, and I'll be talking to you guys in the next training video. In this video, I'm going to be going over double tops and double bottoms and how to actually trade them, how to identify a valid double top and a valid double bottom according to my eyes. Right, so these are obviously reversal patterns found within the market. So the first thing we're going to be looking for, one, is a push down, or a push in the opposite direction. So in this case, a double bottom, we're going to be looking for a big bearish push. Right, once our pretty much level of support is found, we're going to mark off these levels of support. So there's two levels we're going to be looking at. The first one being the lowest close, right? Meaning that the lowest candlestick close, right? We're going to be marking that off. So this right here is the lowest candlestick close, right? So now the second level we're going to be looking at is the lowest low. Pretty much the lowest price action has reached, the lowest wick, if you want to think about it that way. So I'm going to mark this off two different colors. Red is going to be the lowest low, then blue is going to be the lowest close, right? So we're going to be looking at these two levels here. One, so let's actually make some rules, but let me explain this after. Right, so really quickly, we're going to see a push in the opposite direction, right? We're going to be met with, in this specific case, we're going to be met with buying pressure at a certain level. Sellers are going to come back into the market to try and make new lows, but ultimately there's going to be more buying pressure and they're going to be rejected. This is going to be the retest we're going to be looking for. Now, in a double bottom and double tops, I do like to see a space in between price action, right? So maybe something like this isn't going to be valid, right? I do like to see a space within price action. So, double tops and double bottoms are going to be used to spot potential reversals. Pretty much, you can think about it, these are pretty much one of my favorite patterns to trade, because we know very clearly where our stops and entries are going to be and what makes it valid and invalid, and a lot of these patterns look a lot clearer than other patterns, right? So specifically what we're going to be looking for is a gain of momentum, and then a loss momentum, and then a gain of momentum, right? So a gain of momentum, a loss of momentum, and then another gain in momentum. So this is a very clear double bottom pattern here on the index US 30, right? So now again, what makes this pattern valid? So when we see a retest, we want to see a retest of the lowest close, right? The lowest close, this blue line, we want to see a retest of the lowest close, right? We can close all in this range here, but we cannot close and break under this actual lowest low here. We cannot close under the lowest low here. We can close above it, we can touch it, but we can't close under it, right? So this is a very nice double bottom pattern here, right? Now, right here, this will not be a valid double bottom because we did not retest the lowest close. This candlestick right here, this bullish candlestick, is what makes it a valid double bottom because we retested and touched the lowest close, right? There's multiple ways you could trade this. You could potentially use buy limit orders at this level here and then put your stops down here. You want to test out to see what works best for you, right? Doesn't matter what works best for me, it's what works best for you. You can enter after the engulfing, you can enter out a buy sell limit order. It all depends on you. So this is a valid double bottom. Now later on throughout the course, we're going to look at how to make multiple entries with double bottoms, right? You have your second chance entries and you have your aggressive entries and so forth. Okay, so that was an example of a double bottom. Now let's actually move on to a currency pair because I want to show that double bottom because it was a very clean one. Actually, let me see if we have another potential double top pattern here as well. Not seeing anything too clear just yet, so let's actually just move on to a currency pair. This is on the hour time frame, and again, these same rules apply for all time frames. So let's go to here. Let's actually change the chart to USD JPY OANDA, just so it's a little more clear. Let's go to the 4 hour. Right. Okay. So now Again, we're going to be going over double tops and double bottoms here, right? Maybe let's go to the hour time frame. The hour time frame may be a little bit more noisier, so now let's stay on the 4 hour. Now these almost the same rules apply to the actual double tops as well. So again, all right, let's just start writing these rules. So rule number 1, we need to see a retest of the minimum retest lowest close. This is for a double bottom, by the way. Rule number 2. Okay, rule number 2. Then rule number 3. Stops go 5 to 10 pips under the lowest low. And again, you know, you can modify pretty much any of the other rules. So like stop losses and entries, you can modify that to kind of accumulate you, or pretty much you can modify any other rule except for these two here, right, to kind of accommodate your needs, right? So rule number 1, minimum retest of the lowest close. Rule number 2, cannot close under the lowest low. And then rule number 3, stops go 5 to 10 pips under the lowest low, and then so forth. So that's for a double bottom. Let's make the double top rules. So double top rules. Rule number 1, minimum retest of the highest close. Rule number 2, we're going to see cannot close above the highest high. Rule number 3, stops go 5 to 10 pips above, I can't type today, above the highest high. Okay, so now we already went over an example of a double bottom. Let's go over an example of a double top. So again, we found price action playing around this area here. So we had a bull push right there, right? So the blue line is going to be our highest close. The red line is going to be our highest high, right? Highest high being this wick, highest close being this candlestick here, right? So we're going to go from the highest close and then work our way up to the highest high. Now, again, you know, we do have that V pattern here. We do have a small space in price action, right? So notice what made this pattern valid is this bullish candle here. We had a pickup, we had a pretty much pickup in bullish momentum, right? Bullish momentum picked up here. Then we lost bullish momentum, but that's not what made it valid. What made this double top pattern valid here was that it retested, it touched the minimum of the highest close, right? It retested the highest close. And then, you know, you can decide how you want to enter, if you want to use limit orders, if you want to enter next candlestick. It all depends on you. If you want to enter after an engulfing, it all depends on you. So this is an example of a very clean double top here as well. Then we have a potential, another example here as well. Again, same rules apply. We're going to go from the highest close to the highest high. Yes, the candle that made this pattern valid was this bullish candle here. It retested the highest close, and then we had a rejection of that right after. So that's an example of a double top. Now I'm going to see if I can find an example of another double bottom pattern here as well. Right here would be an example. Okay, let's do this here. Right, let's do the double top. So I'm going to grab these two lines. I deleted them. Okay, so we have our highest close here. We have our highest high right here. Notice how when the market came back up, it closed above, right? We would have never entered this trade, right? Unless this candlestick came, touched it, this would have been the activating candle, but this candle came and closed above the highest high, making it an invalid double top. Now for the double bottom, right, we're going to use this example here as well, right? Notice how this, when it came down again, right, we had a bull push, it came down. This is actually a valid double bottom pattern here as well, because we didn't close under the lowest low. So the lowest wick would be here, right? Or actually, it would be right here, my apologies. In real time, it would have been there, right? In real time, this would have been the lowest low here, right? But then this candle made it a new low, okay? So then in real time, this would be a valid double bottom pattern as well. Not the cleanest for sure, but definitely it would have been a valid double bottom pattern there as well. So then I'm trying to see if I can find an invalid pattern there. So again, this would be an example of an invalid double bottom. So we're gonna go from the lowest low, right, to our lowest close to our lowest low, and clearly we closed under, making this an invalid double bottom pattern there. And then this right here, if we go from here to here, right, from our highest close to our highest high, this is a valid double top pattern. This candle here is not what made the pattern valid. It's this candle here that made this big wick that made the pattern valid. Why? Because we retested a minimum of our lowest close there. Okay, so that's the candlestick that made the pattern valid, right? So hopefully by now you understand double tops and double bottoms and these simple price action patterns here. So again, if you have any questions, you can contact me in the private Discord, and I'll be talking to you guys in the next training session. So in this video, I'm going to be going over actual rising and falling wedges. So getting out my notes here. So overall, when we're talking about rising and falling wedges, these are counter trend trading patterns. So you definitely don't want the biggest take profit areas or the biggest targets when trading these actual patterns. It's fairly short term. So overall, how you can actually think about these patterns is we're going to have a really big push of momentum, some kind of break where we'll see the actual pattern form, and then a pullback, and then potentially what you're trying to catch is the pullback. So you're going to know it's typically very short. Now this video itself, again, just like all the other videos, is just explaining the patterns. We're going to be kind of tying everything together within future videos and sections of the course. Sorry for my phone kind of blowing up there. So a rising channel. Normally what we'll see is, let me first of all get rid of this line here. Normally what we'll see in a rising channel is one, a big kind of strong push momentum, then a break where we'll see the actual pattern form, and then most likely a push to the downside. Now of course it's not always going to be 100%. I'll show you an example where it did form the pattern and did complete, then I'll show an example where it didn't. So again, a rising channel will have a high momentum bullish move, a slope or speed, or a slope of speed of price decrease. So what I mean by that is, again, high momentum bullish move that's going to be normally very steep, and then we'll see it kind of decrease. So what I mean by the slope is obviously this. Instead of it completely just going up, we're going to see it kind of move sideways in a specific direction. Normally we'll have a breakout in the opposite direction. Now a falling channel is a little bit opposite. So I actually already see a rising channel here, potential one here. So we had a big high momentum kind of push here to the upside, then we had that rising channel right here, then we had that bearish engulfing candlestick that closed under. Notice it closed under the lows of all the previous candlesticks there. Then we had a breakout to the downside. So that was the actual one that actually played off correctly. Now I'm gonna find you that example that didn't play off, and normally you would have gotten stopped out if you actually took that trade. But we had an increase of price action here. We saw a little slope and it continued to go up, but this specific channel here didn't meet the actual criteria. So later on we'll be getting into the criteria how to actually trade these patterns. Now I'm gonna look for a bearish example on the actual charts here, where we could see a falling channel, and then we will continue the actual video itself. Okay, so over here we could see an example of a falling channel. So we had a very strong kind of decrease in price here. Then we had the falling channel here, so we could probably put it like this. We had the falling channel, and again we had a kind of bullish breakout. So the upside, again, nothing on this pattern is short term. These are just very simple, small counter trend trading patterns here. Now again, you're not going to be shooting for big targets when you're trading these patterns. You just want to pretty much kind of get your 1-to-2 risk reward ratio when trading these patterns, potentially even a 1-to-1. So this will be more of a scalping pattern. So again, we'll go over to actually how to actually trade these patterns later on throughout the actual course itself, and then we will continue that. So what I want you guys to do is pretty much look for a couple of examples of a rising or falling wedge. You want to look for 10 examples of both, and then I will talk to you guys in the next training episode. So again, I'll just recap. A rising wedge, we have a high momentum move, a high momentum bullish move. We'll see price slowly start to kind of decrease in slope, meaning it'll start kind of trending sideways at an angle, and then a breakout in the opposite direction. And again, with a falling pattern, it's pretty much all the same thing, right? With a falling wedge here. So we'll see a high momentum bullish or bearish move, a decrease in price. So here we have here's actually another example here. So here we have a high momentum bullish or bearish move, a decrease in price here as well. We could draw it from here, and then a breakout to the opposite side. So fairly simple. I want you guys to go find 10 examples of each, write them down in your journals, take pictures of them, take snapshots, and memorize these patterns. And I'll be talking to you guys in the next training video. In this video, I want to be going over ascending triangles and descending triangles. I don't really use flag patterns all too much, even though I know a lot of people like to use them. So, you know, I'm not really going to implement something in my course which I don't use. So, but patterns I do use are the ascending triangle, being this example here, and the descending triangle being this example here, right? So normally these patterns are going to be after a high momentum move, right? After a high momentum move, and pretty much this is just another example of a pullback or a relief, the market taking a breather. So, you know, an example I like to use a lot is more or less like somebody going out for a long sprint, and before they sprint, they tie a rubber band onto their waist, onto a pole, and they have a really big sprint, which would represent a high momentum move. Then as the rubber band is getting tighter and tighter, the tension in the rubber band is building, you're going to have one of three examples happen. So you have a really high momentum move, and either you're going to get a really strong pullback, you're going to have a high momentum move, or you're going to have a pullback that looks like this, or you're going to have a high momentum move, some consolidation, and then a continuation to the upside. Now, this specific one here would be a flag pattern, but if you have a high momentum move and then you kind of have like a ascending triangle, essentially it's the same thing. They're both going to break out most likely to the upside. Again, no pattern is 100% profitable. No pattern is has 100% kind of hit rate, I guess you could say. So with an ascending triangle, you're going to have a high momentum bullish move, followed up by an area of resistance here. Now, this is a textbook example, but regardless of the fact, what's going to happen here is that bears are going to try and push the market down, bulls are going to be met with selling pressure, then bulls are going to try and push the market back up. They meet resistance again, where they're met with selling pressure. So here you're going to have your first kind of higher low point here. But overall, it's not a real higher low point until your previous higher low point is broken there. Right, so unless your previous higher low point is broken, it's not a break of structure. Unless your previous higher high is broken in the result of a new higher high. So let's say the market were to do this and come up to here, then this would be your higher high, then this would be your higher low. This would be a valid higher low point. But unless the market makes a new high, then you can't consider this to be the actual higher low point. The market could completely drop back down and then continue to go back up, and that would be your higher low point, right? Okay, so again, you're going to have a really big, strong, high momentum bullish move, followed up by a pullback, which bulls again are going to be met at resistance, where they're going to be met with selling pressure. Then the first signs that an ascending triangle is forming is when you have this kind of higher low here, right? So if we look at the lows, each low is getting higher and higher, and eventually it's going to break out to the upside most of the time, right? Again, you know, no pattern is 100%. So there are going to be patterns or times where it's going to go like this and then just go down, or potentially just continue to go down from here after it's met at resistance. No pattern is 100%. Keep that in mind, right? That's why you want to be able to use proper risk management and keeping the patterns that are profitable within your trading playbook. So this is pretty much the formation of an actual ascending triangle. Now a descending triangle is the same thing, but it's just the opposite. You're going to have a high momentum bearish move followed up by some pullback, where then buyers are going to be met with selling pressure, and the market is going to start to come back down. You're going to be met at support where bears are met with buying pressure here again. Then the market is going to pull back, and then slowly you're going to be making lower highs. So that's another sign that a descending triangle is forming, that you're met with a lower high, where bears are met with buying, or where bulls are met with selling pressure again. I'm sorry, I can't speak today for some reason. Anyways, so again, you're gonna have the same thing form here. You're gonna be met with selling pressure here, and at that point, you know, you can have your point A and your point B, and you want to draw it out into the future. So I'm gonna go onto the chart and look for examples of this, and then we'll continue the actual video there. So I've been trying to find textbook ascending and descending triangles, but you know, the reality of trading is most of the time you're not going to find a textbook ascending triangle or a descending triangle. So I found a descending triangle here. We were met with a high momentum bearish move, pulled back up, buyers were met with selling pressure, market came back down, then bulls were met with, or bears were met with buying pressure, came back up, formed this lower high point, and then broke out of that kind of descending triangle pattern there. So that's just one example there of a descending triangle. Now I'm going to be trying to look for another descending triangle that has a that has more of a textbook type of look to it. But other than that, I'm also going to be looking for an ascending triangle as well. Okay, so found another pattern here. So here we have a nice bull push there. Here the market found its highs where it found resistance. Then we had the ascending triangle right there. And as you can see, this trade definitely didn't last long. The overall bullish trend didn't last long at all, as it broke above, kind of made new highs, and then came right back down. So again, you know, this pattern did go in that direction, but no trade no trade on this specific pattern or on any pattern is 100%. So that was just one example there. Potentially, you know, you have another one right here as well. You have a high momentum bullish move. Now with these specific patterns, it's not always that it's going to be on a high momentum bullish move either, right? Sometimes you could find these patterns in plain consolidation as well. So here's an example of another one of these patterns where you have an ascending triangle there as well. So if we look at the lows, we're getting higher each time there's also, that would have been an indication that it would have been an ascending triangle there. So, you know, those were just two examples of each. Now what I want you guys to do is obviously go back into the charts, go back into the previous history of the charts, and then look for these patterns there. So last but not least, here could be another example. We have a very nice high momentum bearish move, followed, and we're met with support here. And then we have that descending triangle pattern there as well. So again, you know, not all these patterns are going to be textbook. Some of them, you know, when they are textbook moves, then you do want to be able to take advantage of those patterns there as well when you do see the textbook moves. So a lot of the times you're not going to see those textbook moves. That's just the reality of trading. So again, I will be talking to you guys in the next trading video, and I want you all to look for 10 examples of both the ascending triangle and descending triangle. So in this video, we're going to be going over RSI and this indicator here. So I only use RSI, you know, in certain cases, mainly in cases when looking for overbought and oversold conditions and for divergence. So the settings I use on RSI are a little bit more extreme. So I have the 80 and the 20, as normally people would use the 70 and the 30. And I also have the length at 7. So let me actually just get my settings out for the indicator. The length is at 7, and I have the 80 and the 20. So they're more extreme overbought and sold conditions. But the main reason we use this indicator for is to look for overbought and oversold conditions. Now, just because the market's overbought, it doesn't mean that it doesn't have potential to keep going up. So as we could see right here, I don't know if I can even draw on this. We can see right here the market was overbought, and if we look at price action right above, it continued to go up. Right, so we want to be looking for those conditions. Now, you know, again, we could use RSI to kind of add confirmation or add kind of some certain details to our actual analysis, but it won't change our analysis. Again, we're only mainly going to be using this tool to look for overbought and oversold conditions. So potentially we're going to be going down into actually implementing this tool later on, but it's just kind of learning how to use the tool and how it works. So a big thing about RSI that I do like is divergence. So we could clearly see that on the actual chart. So there's an example of divergence here. So if we look at the actual price chart itself, here we kind of have this pattern here where we retested resistance twice. And if we look at RSI, the first retest is higher than the second retest, but that's not exactly the case. We have two conflicting stories on the actual price chart. So on the actual price chart, the second retest is higher than the first retest. So we could clearly see this on RSI right here. So this would be an example of bearish divergence. Now, you know, you could use divergence for many ways. A lot of people like to say it's the banks trying to push the market in the opposite way, and this tool's just kind of helping us there. Yeah, sure, that may be the case as well. So you want to be looking for these types of divergence. Okay, so now let's see if we can find an example of bullish divergence here. So I'm going to be looking for a form of a potentially a double bottom that's flat. So here RSI is actually flowing with the chart itself. We have that first retest, and the second retest is a little bit higher, and we see RSI flowing with the chart there. Right, so that would be that wouldn't be an example of bullish divergence there. And then RSI is also flowing with the chart here as well. So these aren't the best. Okay, so here would be an example of bullish divergence. Notice how the market has gone flat. It's kind of nowhere to go, right? And then RSI, it's actually looking like it's pushing upward each time, right? So that's two conflicting stories there, right? And then as you can see on this example here, the chart is flat, the price action chart, RSI is flat as well, right? So these are two stories that are congruent. These are two stories that are conflicting. This is bullish divergence. This is RSI flowing with the chart normally, right? So again, you know, that's flowing with the chart as well. I'm trying to see if I could potentially get a double bottom pattern here. RSI is flowing with the chart there as well. A lot of the times, just like we saw, you know, we'd have some form of a double bottom, right? That could be flat and it's a pretty symmetrical double bottom, right? But on RSI, it looks something like this. This is the example I'm trying to find here, which I'm surprised I haven't found it. It happens quite often, right? On RSI, it'll probably look something like this. So maybe a little bit, let's make it a little more dramatic, right? This will be the price action chart. This will be RSI. So I'm trying to find that example there, but overall the market is downtrending there. So potentially see if I could find one right here. Right, so here would be that example I was kind of talking about, right? So here we have a double bottom where on the price action chart it's flat, but on RSI we clearly see two conflicting stories. We see two conflicting stories there, right? So again, this video is mainly just for identification. So again, we have overbought and oversold conditions. We're using the 80 and the 20. And then the length is going to be 7 there as well. So those are extreme overbought and oversold conditions. So when the market goes overbought, that could be an indication that it's running out of steam, and somewhere in the near future we could be looking for a potential pullback or a reversal. Again, just because the market says, or RSI says, it's overbought, it doesn't mean it will go down, right? So every time I see someone post in the chat, oh, RSI is overbought, you know, it's gonna go down, it will go down, you have to be very careful with that, because that potentially could be a bad psychological effect on you as well, because the market does what it wants. Keep that in mind. Just because a laggy indicator says the market's overbought doesn't mean it will go down. So you can see, we could see that example here. It was overbought here. Did it go down? Yeah, a very short amount of time, but it went right back up after. So I really wouldn't use RSI to overall counter trend all too much unless it's a reversal where we see a very symmetrical double top and then there's a divergence on RSI. Right, so again, back test this indicator, look at divergence. So I want you guys to clearly find forms of divergence, look for overbought and oversold conditions. I want you to find 10 examples of each. Then also look for some form of a double top where you see RSI divergence as well, right? And then look for those types of patterns here. So it will be talking to everybody within the next trading video. So this was again just for actually there's another example right here, right? So let's notice this example is a little bit different. This is another example of bullish divergence here. Now notice how it's pretty flat on the price action chart here, and we see that bullish divergence there as well. Again, two different stories, and then potentially this is another example of bullish divergence there. So again, you could use this to build a case. I wouldn't necessarily use it for anything else or base a trade off of RSI. Again, if I saw this double bottom and the engulfing here, I would take a look at RSI. Okay, we have bullish divergence. What's the risk to reward? Potentially, I could be looking at a 68 pip risk for a 80 pip or 90 pip reward. Is the trade worth it? Then you can go on from there. So again, there's another example of bullish divergence here, right? So this is GJ on the hour, right? There's another example of bullish divergence here. I'm getting into way too many examples here, but as you can see, double bottom is flat, and then we have divergence on the RSI. And then again, if you saw the double bottom first, then you saw the engulfing candlestick, the breaker structure on lower time frames, and then RSI had divergence. You could add that to your confirmation list. So later on throughout the course, we're going to be getting into a ranking system and making a ranking system, right? So then from there, you could add that into your actual ranking system on the trade. What type of rank did this trade get? The risk to reward. Let's say we're going to be risking potentially 55 pips, and then to see the nearest high is 35 pips or 37 pips. And if you're looking for a reverse, we could potentially go for more than that. But overall, this is just a video of how to actually identify divergence on RSI and overbought and oversold conditions. So again, we have another example here. Just because RSI says it's overbought doesn't mean it will go back down. Vice versa, just because RSI says it's oversold doesn't mean it will go up and change direction, right? It's just a sign for the market to actually start slowing down a little bit, right? So I'll be talking to you guys in the next training video. Now in this video, I'm going to be going over pretty much the moving averages that I use. Now I do use only two moving averages, being the 20 and the 50, right? So we have the 20 moving average being this blue one here, and the 50 moving average being this 50 period moving average being the red one. Now the 21 or the 20 moving average is pretty much my preferred choice along with the 50 when it comes to more or less short-term swing trading trends for like the 4 hourly or the hourly, right? And again, during the trends, price respects these moving averages so well, it'll pretty much signal when the trends actually may shift. Now with the 50 moving average period, it's more or less like a standard swing trading moving average period, which is a fairly popular moving average period when it comes to most traders actually riding trends, because when price comes down to these levels, we're pretty much to look to actually continue the trend unless price actually breaks under the moving average. Then that might be something to look out for. So now, as you can see on the daily time frame, price actually came down to this 50 moving average period or this 20 moving average period, which, as you can see, is used more or less like I say dynamic support and resistance level, right? So price rode above this moving average and then continued to actually trade a lot higher after that, until price actually started to kind of counter trend and consolidate in this range here. Now if I were to break it down to a lower time frame like the 4 hour, we could see that a lot clearer as well, more or less price kind of consolidated along this level and use this level as a level of support and resistance again for a more shorter term trend here. As you can see, price also was riding above this 20 moving average period here, and this 20 moving average was also being maintained blue over red at that point in time. Then you can see price clearly pulling back to that moving average there before rejecting, continue going up. Now again, we could see the 50 moving average again. So this would be an example of a I guess you could say a trade where price didn't actually continue in the longer term trend. All right, so again, we're going to be using these levels as a level of support and resistance. So you could basically think about it, if price breaks under our blue moving average, then I'm going to look for price to reject our red moving average. And again, these moving averages only work best when price is actually trending, meaning price is moving from one side of your screen to the other side of the screen. Notice how price is moving from the bottom left to the top right side of my screen, right? When price is trending, when price is making higher highs and higher lows, right? And pretty much what we're going to be using these moving averages for, like I said again, is for confluence based trades. So I'm going to pretty much find you an example like on the hour time frame. All right, so I'm actually going to scroll down here. So let's actually look at this example here. Notice when price broke above these highs, price actually pulled back down to our 20 moving average. As you could see here, price actually broke back down, tested our 20 moving average where we do have our previous highs, and actually continued to trade higher each and every time price actually came back to our moving averages. As you can see here, like I said again, if price breaks under this 20 moving average, then watch out for the 50 moving average. Price tested the 50 moving average and actually continued to trade higher. Again, if price breaks under our 20 moving average here, then look out for the 50 moving average, and then price actually continue to trade higher from that point on, as you could see there. So let me kind of just lower this. Then you can see this again even more clearly here. Price broke under a 20 moving average, 50 moving average, and then price actually continued to trade a lot higher there, as you can see. Right, so again, the moving averages are going to be areas of more or less dynamic support and resistance, and you know when these moving averages cross, then we may see a reversal in the trend, as you could see here, like on the 4-hour time frame. Right, so again, fairly simple concepts, just put them together in different situations.